The Bank of Canada raised the interest at another quarter point. Well, listen in on what's happening on real estate this week. Is that going to affect you or not? Hey, everyone, we're here. What's happening in real estate this week with Conrad Zerini of RE/MAX Escarpment and RE/MAX Niagara. And we got Brian Hogman here, Mission35, and myself. We're going to talk about how much did that quarter point affect real estate this week, and what's going to happen down the road in regards to, are they going to do another one? Anyway, Brian, the mortgage guy, let's hear it.
Hallelujah. While the economists were about 50-50 split prior to Wednesday as to the rate hike or not the rate hike. So seeing the quarter point on the variable brings it up to most bank prime rates just below 7, right? So I think a quarter point, it's because the inflation numbers were up, GDP was up, and like Conrad likes to say, it's the Bank of Canada's hammer. You know what I mean? They only got the one big hammer in order to really control that fiscal policy. And you know what? We're heating up, right? So the housing market, as we can see over the past 6 months, has been up. And I think the other thing too is that the way that the bond market's trading right now is it likely might not be the last one, depending on the future numbers that we come out. We may end up seeing one next Bank of Canada meetings, July 12th. They take a pause in August, and then we have another one in September. Some of the forecasts I've seen now is we might see another 2 quarter point hikes. We might see another half a point by the time we head into fall. So it's a great time to be looking at fixed rates, variable rates, and making sure that you understand your options out there, because the fixed rate is trading at a considerable discount to the variable rate right now that I don't think should be overlooked for people.
Yeah. I knew I knew this was going to happen just because of the market. It was moving. Conrad, you know the numbers better because
I've said it for 2 months. 2 months I've called this quarter point. Yeah.
I didn't want to believe you, Conrad, but you were right.
I know.
Yeah.
But you know what? The fun. Yeah. Go ahead.
No,
Rob.
go ahead. No,
I was going to say you know what? I'm done with the rates now. Like, who cares? I think Canadian consumers are done with them too. Look, the market is strong. All the other fundamentals, jobs, spending, consumer spending. And what did you expect? We were locked up for 2 years. So now we're seeing the tail end of the people, they're getting into travel. Like, that's the next frontier. Like, they want to spend their travel dollars. Everybody looks at things like that. I got so much money to travel, so much money for shelter and restaurants and entertainment. So we're in that next little wave, and they're all spending that money. And I think the Bank of Canada didn't expect it, that the Canadian consumer was so resilient. And they're in the next phase of travel. And we saw them buy houses when they got out of the pandemic. And then now they're into the travel piece. Now we're going to see the housing piece come back again, and to see that market. I don't think rates are going to matter anymore. I don't think so. I think people are just going to say, I'm going to move on. I'm not going to be held by this number, this rate number anymore. I just think that, jobs are good. That's the one. If you're going to think about it, is there going to be a bubble or whatever, job strength, spending, consumer spending, there's a lot of optimism in the market. The bond, like you said, they're calling for higher rates. We're just adjusting. I think it's just going to be a normal market.
I think you're right.
Now, the one thing is,
you're absolutely right.
I'll say one thing too, which is interesting. Everybody's, go ahead. Yeah.
No, but you're absolutely right.
No, just one little quick point. Everybody's taking 3-year mortgages, right? Everybody's taking 3 years now. Sorry, everybody's taking 3-year mortgages. This is where it's going to be very interesting. All these guys today are taking 3 years. And Brian, you're telling everybody that. The 2021 mortgages are going to come up at the same time as the 3-year mortgages. So those 3-year mortgages, 2026. The 5-year from 2021, those 1.9%, is going to come in 2026. That's when you're going to see this double cohort of financing. But I will tell you, they're all predicting 2020. You said it, Rob. 2025, 26 is going to be a bonanza. And that's just going to add to the whole picture, right? Yeah.
You know what? I'll tell you, when the interest rates were at 2% and they were climbing half point, I would get calls from realtors. We'd talk to other realtors. Hey, what do you think is happening? What do you think is going to go on? Like, realtors were more scared then. Right now, nobody's even talking. Like even in my office, nobody's even saying, "Hey, did you hear they went up a quarter point?" Nobody's even saying that. That's just like it's kind of like blah news now. Like it's just like, okay, up a quarter, down a quarter, up. No, it's not the big deal. This is going to be the norm for a long, long time. I just feel bad. Even Daniel, my son, he was talking about his mortgage. $1,200 more a month starting his renewal, and I'm going, well, good. Now you're gonna have to work a little more. I go, and I wish everybody's mortgage was renewing on my team. So, they work a little harder. So, and he can he'll be able to afford it, which is not a problem. He's got dual income. He makes good money, but there's a lot of families can't do that. And sometimes that can be a huge effect on it. And just like I was talking to Brian this morning, do not sell your house, whatever you do. Do everything to retain. What was the terminology you used? Retain.
We said it's harder to retain the asset than it is to attain it. It's harder to, it's easier to retain it than it is to attain it. Like to get a house today with competition, to get qualified and everything else, once you get into the housing market, for your owner occupied house, everybody will do anything they can in Canada to maintain those mortgage payments. We've talked about that before. So just, and we're seeing record number of people re-amortize now. And listen, if I'm faced with selling my house or putting my mortgage over a longer period of time to make the payments lower, all day long, I'll take the payments longer. If it takes me another 5 or 10 years, it's not ideal. But guess what? I'm still paying down principal. The amount of net worth I build up if I choose to go rent's really high right now. And it's kind of like going from a car lease to owning a car. Like once you get into a lease, it's hard to get out, right? Because you can't save up the money again to get back into owning it. So we're telling people that all the time.
Yeah, but there comes a time when, this is a great market to cash out of as well. And I know rents are going up and what have you, but I'm not talking everybody, but look, at the end of the day, they're defaulting on their mortgage, not mortgages, but rather their credit cards and car payments. Don't jeopardize your credit picture. No. You've got some equity. This is your opportunity. Take the equity, clean things up. Don't overburden yourself. Live your life. And I think you're seeing more and more people thinking that it's not the worst thing to rent, and maybe they'll cash out and rent and they'll keep that little nest egg of money to themselves. We always think of the one side of the continuum, ownership, but there is an emerging market on the other side, and we're and I'm glad to say, because I'm in that rental space right now. They're an underwriter with CMHC for multi-unit res. Like about a year ago, they were doing 40 applications a month. Now they're like 110 applications for purpose-built rental. So we're going to see some good inventory coming to the market, and maybe it's a time for people to cash out and not have the stress of this mortgage and this debt and everything you have. So let's build up some inventory. And I think you're going to see investors are going to say, you know what, this is time to cash out, and we'll see some of that inventory so more and more people can buy. I think that's really the side I'm looking at, right, in terms of this.
I see it with the investors. I agree on that. My only sort of the black swan event that we don't know about is the mortgage rule changes. And I think for mortgage rule changes, for someone that does cash out of the market, and I've just seen it sometimes, it's kind of like putting money in a bucket with a hole in it. That nest egg that's over there, it just sort of drips out a little bit and drips out a little bit, right? And I think for the savvy consumer, I would agree, the one that, saves, cannot touch it, invest it, and re-enter the market. We see a lot of people on our end that sometimes that money drips away, and sometimes they'll get regulated out of the market because OFSI's looking at mortgage rules and regulations because the market's heated up so much. And some of those people, if they end up getting out qualified, where a mortgage rule change or the stress test increase or something happens, and now all of a sudden they can't qualify again. That's the only thing that worries me for some of those homeowners.
Are B lenders becoming more popular now? Is that because of these mortgage rules, like they're coming out with some heavy duty, rules and regulations. So if you don't have the right beacon score or whatever credit report, even if it's a good credit rating, they're still having to go to a B lender. Is that happening a lot where you see somebody that's just on the brink?
And that's something that I'm part of Mortgage Professionals Canada. It's they do a great job at MPC of advocating for our industry for the consumers. And what we're really concerned about right now is for the public. If these new mortgage rules come out, it'll just push people into higher interest mortgages, right? So now it pushes someone in who would normally get qualified at a bank under tighter restrictions. Now instead of paying 5%, they're paying 7%, or they're paying 8 or 9 in a private. So we are seeing, not so much on the purchase side, but more so for people who qualified for a mortgage 4 or 5 years ago, have a little bit of debt now and want to refinance. We're finding that in more situations now than in before, it's going to one of those alternative lenders over a 30-year. We still have some lenders which will do a 35-year amortization in order to pay out the debts. And now they're paying considerably more for the mortgage. But, and again, to Conrad's point, they've got to operate on which side of the teeter-totter they want to, but they want to keep their house. They still have significant equity, and they're able to consolidate some of their debts, but they're paying a premium for it in a lot of cases.
One question. If
go ahead.
A client, if he's got an A lender that mortgaging the house, and he's always late on his payments, could that A lender say, hey, we're not renewing your mortgage on the next term?
They could. I very rarely see it happen, right? Okay. Because like if it's currently in arrears, and they're like, banks are, I have to say, banks are very forgiving when it comes to arrears. Like a bank, because they don't want the PR nightmare. Like if you're 30 days late, they send you a letter. No. If you're 60 days late, they send you another letter, right? Like you got to be really late on a bank. Whereas the law actually states if you're a private lender, you can start the power of sale proceeds after 14 days. It's not ideal, but banks are very good that way. And they, if someone's up to date, I would say 95 to 99% of the time I've seen it, they'll renew it.
So,
well, you know what's interesting? Like, just a quick thing. Yeah. Oh, go ahead. No, I was going to say one thing, and it encapsulates everything what we're talking about. Look, I think that people should make the decision before it's made for you. Brian is correct. There's some changes coming into the market. Absolutely. Why wait for those changes to make these decisions? Because then everybody's doing it. That whole double cohort I'm talking about in 2026. Why wait for that time to happen when there could be shortage of cash sitting out there? It's interesting what TD is doing now. TD is really cutting their rates. Brian, you know this. I've seen some. They've really discounted the rates. Are they looking at the fact that Canadians have equity, and they're thinking that maybe they will get to the point where there's some stress and they're going to take properties back, and that's part of because their short-term strategy is going to cost them money because they're lending out less than everybody else. So what I'm getting at, there's a lot of factors here. I think you got to make the decision. Don't let these government factors, double cohorts, and all that kind of stuff come in and make the decision for you. I think it's time to take control of your real estate destiny and use an agent, use a proper realtor, like somebody from the Golfi team and a proper mortgage person, because that's where you got to be making those decisions on a holistic individual approach. Definitely. Yes, I think there's so many factors out there and they're all grasping at straws. It's entirely, and we're all individuals and we have different needs at different times. Mm-hmm.
So the most expensive house right now listed in Canada is on Park Lane Circle in Bridle Path. So
yes,
Brian, I sent you that. So Brian, what's the down payment required on a big home like this?
Oh God, you know what? I wish I did a lot of these, Rob, but to be honest, I don't. Right? So I don't see too many $40 million purchases come across my desk. So it would typically operate under a sliding scale. So it's 20% down on the first million, then 10% on, or 50% of anything over and above. So you're looking at, on 19 million, you're looking at 9.5. You're looking at almost a $10 million down payment. So
wow. So a $10 million mortgage would be probably $50,000 a month on this place.
Yeah. So I was looking at it. If I took out, let's say, I was fortunate enough to have 50% down, 20 million. I don't, but if I did, I would finance myself at 5.25 over 30 years, and I'd be paying $110,000 a month.
Oh shit! Wow. Now here's one in Naples. I think this is one of Conrad's neighbors in Florida. It's listed at $174 million. Look at that one. So, but there's another one here I sent was 495 million. Now, I mean, if you looked online, if you go on the global search, this is on in Crystal Bay in Nevada, I guess. I don't know. They even got a lift, like like they do in Niagara Falls. If you have to go from the upper part and lower part.
Oh, you're gonna say Crystal Beach?
Yeah, no kidding, no kidding. But I think Conrad, you must have had one house listed the most expensive house in Canada at one time. I think.
I did.
57 million at one time.
Lancaster. Yeah. I did. Yeah. And you know what? It's funny about the numbers. 5 million plus on the Toronto Real Estate Board is up 32%. Sales.
Are you kidding?
Over last year. No, I'm not kidding you.
Wow.
Yeah. There was 30. There was like something like 20 some. Yeah, 20 something were sold last May, and 32 were sold this May. So it's up. It's up. Like I said, almost a third from last year. So yeah, that luxury market chugs along, man. It's awesome.
No kidding. No kidding. Anyway, well, everyone, listen, we're out of time here. Thanks for listening, and Conrad, thank you so much. Brian, thank you, and we'll see you guys next week. Have a great weekend.